So I just have a question on Carvana, if you could kind of, actually it's kind of an industry question. So I'm looking at the UK car dealership industry, and they've kind of increased margins similar to the US a lot due to the supply chain issues. And it's kind of set to continue. So my first question would be, what do you think, will we reach a point that there's basically no more cars to sell? And the second question would be with economic sentiment that, which is kind of the lowest since the global financial crisis, do you think that could have an impact on consumer spending and potentially on cars? I probably know your answer to that one already, but
yeah, I mean, if you're investing in a business for a long term, you don't really worry if consumer sentiment sometimes goes down, it sometimes goes up, but you can't base an investment decision around that. If you decide you believe in where a business is going for the long term, then you expect there to be good periods and bad periods. So that's certainly not something I would pay too much attention to. Maybe for those of you who aren't familiar with it, Carvana is an online seller of used cars in the US. A lot of sectors, as we all know, have moved online over the last decades, starting with Amazon and books and lots of other e-commerce things. But used cars is actually the one thing that is still mostly sold offline. I think the penetration of online cars is 1 or 2%, so similar to pet insurance. But it's a vastly superior experience for customers. You don't have the hassle of going into a dealership, haggling with a salesperson, having this fear of getting ripped off. With Carvana, you just can surf on the internet, choose a car, click a button, and in a best case scenario, the car is delivered to you on the very next day. And I think in the US, there's roughly 40 million used cars sold per year. And Carvana this last year sold around 400,000. So there's a really, really long runway to go. And I think there's no reason why the online penetration couldn't be 10, 20, 30% or even higher in the long run. So that's the reason we're invested. As you pointed out in your question, there's a lot of disruption to the used car market at the moment. So that comes from a disruption originally from the new car market. So when COVID hit back in March 2020, and it looked like unemployment was going to go up into the stratosphere, and new car sales were kind of collapsing, and all of the car companies phoned up TSMC, which is the main company in the world that makes semiconductors, and canceled their orders because they didn't think they were going to need them. And then, what happened was actually the world economy bounced very quickly back from COVID, and because of the importance, because people were less keen on being in public transport because of Corona and everything. Actually, the demand for new cars went up, which is not normally what would happen in a recession. So all of a sudden, you had an increase in demand at the same time the supply was falling. So there's less new cars being made than usual. And the impact of that is people who would typically buy a new car are now buying a used car. So it's creating a squeeze in the market, and the prices are going up, and all kinds of crazy stuff is happening. But I really don't think that impacts our investment in Carvana in any kind of a meaningful way. There's, like I say, 40 million used cars sold per year in the US. 400K of those are with Carvana. So even if the market were to contract, then there's still plenty left for them to do. And in terms of, obviously there's going to be a lot of price volatility with used car prices jumping, and presumably at some point they're going to come back down again. But Carvana, like most car dealers, actually they turn the inventory very quickly. When they buy a car, they typically sell it within about 6 weeks. So you might have a very short-term impact where when prices come down, they take a loss on or less profit, more likely on some of the cars they have in inventory, but then they start buying new used cars at the lower price, and that kind of washes its way through. And actually, in general, I think it will be good for the used car industry when prices come down, as that will stimulate demand. So, so overall, I think it's not a problem, and it's not really central to the way I think about the investment.
Thank you. Perhaps like one follow-up on
Sure.
EVs, because kind of there is a question like with EVs that it's a lot about batteries. Mm-hmm. And if the battery only lasts like 10 years, there won't be a used car sale. How do you think that plays into the equation? Because in some sense, I think the transition probably boosts used car sales because there's not enough maybe infrastructure for those EVs. But then like later on with EVs, when they take over, do you think that would still be the right investment?
Yeah, so you know, there'd be a used car market for EVs in the same way there's a used car market for combustion engine cars. So I don't think it will change the size of the market. You know, I think one of the questions that I had was to what extent, you know, Carvana, one of its key competitive advantages, it has a lot of capacity to recondition cars. And, you know, to the extent, you know, electrical cars require far less maintenance than combustion engine ones. It's, you know, so one of the questions I had was to what extent that could negatively impact Carvana's business. But from what I understand, Carvana doesn't sort of do sort of mechanical work around the engine or anything like that. They sort of repaint the car, take out the dings, make sure it's clean inside. It's the kind of stuff that you'd have to do for an electric car as well.
Thank you.
Okay, thanks.
Rob? Yeah, this is Paolo from Milan.
Oh, Paolo, hi.
Hi.
There you are.
Following up on Carvana, I would like to ask a question about I would say, the direct competitor in the US, which is CarMax. Probably when you studied Carvana, you also looked at CarMax, I assume.
Yeah.
And CarMax now also has the online channel.
Yeah.
So I was wondering why, at the end of the day, you decided on Carvana rather than, for example, CarMax. Also, obviously, you saw some advantage on Carvana versus CarMax, and I would like to understand that.
Yeah, I think I did. I mean, at a high level, I admire CarMax enormously, and you know, CarMax sells about 1 million used cars a year versus 400K at Carvana versus 40 million in the whole of the US, and you know, so there's plenty of market for both companies, and I think both can be successful without the other having to fail. But that doesn't answer your question of why Carvana versus CarMax. And you know, I think the really big opportunity in used cars is online. You know, online is, you know, next to nothing penetration today, and over time will be far bigger. And to me, you know, and I guess some CarMax investors might say, well, CarMax is perfectly positioned for that. If you want to buy the car in store, they have stores, and if you want to buy a car online, they have an online place, so they can serve both constituencies. But in my view, that's not the way it works, because if that was the way it works, you know, department stores would have, you know, been the big successes in online and not Amazon. You know, you would have said, well, in the department store, if you want to buy the good in store, you can just go in store, and if, you know, they have online shops, and if you want to buy online, you can buy it online. And of course, that's not the way it works, because for online, you require completely different infrastructure and cost structure than you do for offline. For offline, you have expensive real estate in well-situated locations. You have lots of qualified salespeople running around. You have a logistics infrastructure that can bring inventory into all your little stores dotted around the place. And that's really just a completely different setup to what you have online. Online, you have a smaller number of very large fulfillment centers and a hub and spoke network to deliver the packages or the cars, whatever it is to customers. And the last thing you want is the expense of holding inventory in lots of different locations, of paying rent, of having salespeople standing around idly. So in my view, it makes sense if you're focused on online to have a pure online strategy, and if you're focused on offline to have a focus on offline. Trying to combine the two, I don't see any synergies in that.
Regarding Carvana, what's your take on their latest acquisition, as it may have as they increase the debt and therefore maybe the risk profile in a time when it's like a working capital intensive business and they are not generating cash flow?
Yeah, so Carvana announced an acquisition a few weeks ago of Adesa. And Adesa is a company that runs physical auctions for used cars in the US. So the way the market typically works is dealers purchase cars at wholesale auctions to put on their lot, and then they get sold from the lot, obviously, to the retail customer. And Carvana bought this business. It's a nice business, a mature, probably modestly declining business, but with a decent amount of cash flow. But really the main motivation to buy it was, as you can imagine, it's an old business, so they have these auction sites dotted all over the US. I imagine in very good locations, probably out-of-town locations 50 years ago, but probably, given the way cities have grown, probably much more central locations today. And these locations have a lot of excess land on them. And Carvana's plan is to build, IRCs, so inspection and reconditioning centers on these plots, and use that as a way to build out its network. It strikes me as a really, really smart thing to do, which will accelerate its footprint. As anyone who's ever built anything knows, it's really difficult to get approvals to get something built, and there's always lots of opposition and stuff. And these are plots of land which are already approved for used cars and stuff. So I think it will help them to get to where they want to go more quickly. Now, as you mentioned, as a business, it's not profitable at the moment. It's investing a lot because it's obviously wants to grow very rapidly. And the way it financed this acquisition was with debt. And I'm not a big fan of debt at all. Most of the companies I own have net cash. To the extent they're a lending business, then they would typically have debt, as there's no choice, but they would have less debt than most of their competitors. So it's not something that I'm a fan of. But the way I think about it is, in two ways. Firstly, the debt is held against sort of like physical assets, so real estate in the case of the Adesa acquisition, and used cars, which are very liquid assets, effectively. So it's very low risk debt from the perspective of the lender. And the second thing is, if you look at the shareholder base of Carvana, it's a very wealthy shareholder base. The Garcia family is very wealthy, and a lot of its investors, were the company to need capital, it would be no problem to put capital in. So from my perspective, I don't view the indebtedness as being overly risky, but if I had a choice, I'd prefer it wasn't the case. But there's actually one situation where I've seen in the past, which is actually the exact opposite of this. So in Germany, there's this company called Beiersdorf, which is the owner of the Nivea brand, so the skincare, which I'm sure everybody is familiar with. And Beiersdorf about 40% of the shares belong to one family. And what they do is, the family have borrowed, I don't know what the numbers are now, this was a few years ago, but they had, call it 5 billion of debt privately. And they held 5 billion of cash in Beiersdorf against that. So if ever they had a problem servicing that debt, they could just simply take the capital out of Beiersdorf to service it. And from the perspective of Beiersdorf shareholder, it kind of sucks because they're getting all the juicy returns from the investments they're making, and then you're stuck with this cash, which is at the time it was yielding 0. Over recent years, it's probably had a negative return. So I wasn't super keen on that either. And in a way, I'm not a guy who particularly likes leverage, like I say, but in a way, it's actually quite an interesting situation with Carvana that you get to kind of piggyback on this leverage in a non-recourse way. If it works, the returns will be way better than they would have been. But if it doesn't, you can always just kick in a bit more equity. So I have mixed feelings about it, but I could see some upside to it as well.